Thank you for taking a few minutes to learn more about the investment and tax advantages of purchasing residential single-family homes as an investment vehicle. I'm sitting here with Michael D. Finn, founder and president of IBAREE, Investors Business and Real Estate Emporium. Hello, Michael.
Hello, Jason. Thank you, and thank you to those of us joining us today.
Michael D. Finn is a licensed real estate broker, attorney, and former certified public accountant. He was first licensed as an attorney in Michigan in 1970, a CPA in 1974, and a real estate broker since the early 1990s. Mr. Finn is also president and actively involved in the daily operations of Finn Law Group. I should note that Mr. Finn is not an investment broker or banker.
Because this presentation is in recorded format so that you may view it at your convenience, you won't have the opportunity to ask us questions in real time. We are happy to receive your questions via email or telephone. Simply click the contact link on our website after this presentation to get a hold of us.
So, Michael, real estate as an investment.
Real estate is like all investments. One must measure the return on investment against the risk. Diversification is the key to spreading out that risk by spreading it among more than one investment vehicle. Where single-family residential may fit in, your portfolio is entirely up to you, with perhaps the advice of your investment counselor. This is where I reiterate that I am not an investment counselor. Obviously, real estate's most serious consideration must be its relative lack of liquidity. This then would suggest that a well-rounded portfolio should contain significant liquidity.
All financial markets have peaks and valleys. So how do we know this is a good time to invest?
Timing is important when entering any market. We feel this aspect of real estate, that of residential single-family homes in stable housing neighborhoods priced in the $90,000 to $175,000 range, and of the configuration currently most popular, 2 to 3 bedrooms, 1.5 to 2 baths, a 1 to 2 car garage, are at historic low levels and should begin to reappreciate significantly over the next 5 to 7 years.
On screen, we see a quote from a recent Tampa Bay Times article that indicates that we've felt the bottom of the market and that the market is in the process of turning.
A recent Wall Street Journal article reinforced this same message, Jason, that of a relatively low-risk investing in stable, family-based housing in middle-class neighborhoods.
You talk about houses as an investment, but for the prospective occupant, there's something more important. They satisfy the basic need for shelter. Mortgage rates have never been lower. Shouldn't everyone be buying a house?
While it's true that mortgage rates are at their historic low, many potential homebuyers are simply not able to get back into the market because of credit and/or down payment issues. So presumably, the best purchase deals will go to those who recognize the value at today's prices with the intent to resell in 3 to 7 years to optimize appreciation rate of return, a profile more of an investor than a typical home buyer.
I see. You've shared with me before the tax advantages of investing in real estate, and there seem to be many. Can you share with our audience?
There are many, and they are major. They include your ability to offset against ordinary income, the non-cash deductible expense known as depreciation. Current IRS regulations permit you to deduct about 1/40th of your capitalized investment as depreciation every year. Since your intent is to at some point resell your investment at a profit if things go as planned, the depreciation write-off allows the deferral of taxable income until after the sale, and capital gains treatment on all profit beyond your original cost. Depreciation recapture is taxed at ordinary income rates, but even that is avoidable if you acquire your real estate investment through your IRA, 401k, or other permitted retirement plan. We will talk about that in a little bit more detail shortly. Beyond depreciation, all expenses reasonably related to your investment, including things like Travel costs to oversee your investment are tax deductible and therefore an offset to ordinary income. Generally speaking, if you opt to use funds not in a retirement plan to acquire your investment, you will still see very favorable tax consequences, such as those just indicated, from the time you buy right through to the time you sell.
Acquiring your investment through your retirement plan is something not generally understood. I know that third-party plan administrators prefer to invest your funds in stock, bond, or money market, or some combination thereof, because those are their products, so they like to promote them, and not other investment vehicles like real estate. As you mentioned earlier, the traditional retirement funds are typically quite liquid, meaning you can convert them to cash relatively easily.
My real estate investment concept incorporates the idea of leaving a significant portion of your retirement funds in liquid investments within your plan, but also encourages diversification by utilizing a portion of your funds in a self-directed retirement plan that facilitates investing in real estate among your options. For specifics as to the mechanics of obtaining a self-directed plan, which allows you to shift, not distribute, and that distinction is important, a portion of your retirement plan into a self-directed retirement account, which is absolutely sanctioned and permitted by the IRS. I am most familiar with a company called Advanta IRA, formerly known as Entrust. I know the operators of the local Largo, Florida office, and I'm happy to refer you to them. Jack Callahan is the president and a licensed Florida attorney, as is Jack's associate, Scott Maurer. Their contact information will be provided to you at the conclusion of this presentation, and their website has some terrific information on it. Jack and Scott regularly lecture and sponsor seminars throughout the area. So if investing in real estate through your retirement plan is a viable option for you, a lot of information to accomplish this, plus the vehicle, Advanta IRA, an IRS-approved self-directed plan administrator, is readily available for you to do so.
To summarize the advantages to investing in real estate via your retirement account, let's refer to this slide here. This advises that all gains are tax-free until disbursement, and if a Roth IRA vehicle is used, they remain tax-free?
That's absolutely true, as tax consequences of investment gains go well beyond the scope of this presentation. Remember, Jason, I said I was a former CPA. I'll conclude by suggesting you obtain the Advanta materials and forwarding same, along with my website address, to your tax advisor. The bottom line is that the tax treatment is at least comparable to your other investments, and at best offers some short-term tax advantages your typical investment plan does not include. One last interesting observation before we move on is that your self-directed plan can partner with other plans, perhaps owned by a friend, relative, trust, or other individuals, even yourself. You, as an individual investor, can partner and combine investment dollars with your self-directed IRA to acquire the real estate you desire to purchase. Since the best real estate deals on the market are going to those that you purchase outright without the benefit of a mortgage, our vision is that by using your retirement or savings account dollars for your acquisition, you'll not only be able to drive the best purchase bargain, but you'll be able to close your purchase quickly, which will be important to your awaiting tenant. More on this concept momentarily. Therefore, should you not conveniently have the necessary funds on hand for the purchase you'd like to make, the ability to partner up your investment with a friend, family member, or even yourself, along with your IRA or 401k, may be the way you'll determine how much of an investment you and your group will want to invest.
Okay, Michael, I think we get the funding portion. Talk to me about the business plan.
Rather than have you, the investor, select the home to acquire, we match you, the investor, with a pre-qualified tenant for the home before the home is even purchased. The concept is that we're trying to build an exit scenario for you, and attempting to match you with your new tenant and future purchaser. More on that concept in a little bit. Then with you, the investor, retaining the ultimate buying decision, the tenant selects the home of their choice from the available MLS listings and or a bank-provided list of properties in their portfolios in the tenant's desired area. By allowing the tenants their choice, we feel the tenant will have that much greater an incentive to exercise their option to purchase the property from you when they are in a position to do so. Second, and more importantly, the rate of return you can realistically expect from your rental proceeds translates into a 7 to 9% rate of return pre-appreciation. Please refer to the schedules attached to the website for the specifics of how these rates were calculated.
Okay, this illustrates projected anticipated cash flow on a $100,000 home purchase at a 10% rate of return. Why 10%?
As stated, the non-appreciation rate of return from lease collections only is 7 to 9%. So it's fair to anticipate an additional annualized rate of return from appreciation of the asset, that is to say, appreciation of the real estate itself. As indicated previously, we recommend purchasing with cash to obtain the best purchase price. We build in a minimum acquisition price to the tenant of 120% of the investor's base of the purchase price, plus any improvements over the 2 to 3 year projected rental period. We believe this number is realistic, particularly if you purchase at the bottomed out price with cash to obtain your best deal. Over a 2 or 3 year period, the tenants who have selected the home initially and made improvements over this time frame will be paying a fair price if they pay 120% of the initial cost. Going back to this slide, at 10%, we're only attributing a 1 to 3% annual appreciation rate, which we feel is low given the added 6 or 7% annually should the tenant buy at our projected 120%. Even at a modest 100%, the initial $100,000 cost adds up to $161,051. In short, we are representing a very conservative estimate of the sort of return that can and should be attained.
Well, this slide provides an example of a realistic and still quite conservative investment, and in this case, $100,000 becomes $178,000 over just 6 years. I'll pause for just a moment for our listeners to take a look. So how do we get started?
We can refer you to Advanta if you do opt to use your retirement funds to make your purchase. IBAREE then locates your qualified tenants, handles the property acquisition as your real estate broker, and thereafter manages the property right up to the date of resale. Our intent is to allow a typical investor to acquire real estate with absolutely none of the typical landlord hassles. IBAREE does it all. Its management fees are built into the rate of return, so the numbers you see include the 7% management fee already deducted. The investor has the identical investment experience he or she has with any other market, receiving a monthly accounting with their check. No concerns about locating or vetting a tenant, and hopefully a built-in exit scenario if the tenant ultimately purchases the home.
Quite a concept. It makes common sense, but isn't necessarily intuitive, or we'd have been doing this long ago. Talk me through the steps.
IBAREE marries the tenant to the home from day one, thus ensuring the tenant has the desire to own this specific home as soon as possible. The investor sets the parameters for price and location, and IBAREE pairs them with well-matched tenants. We identify and pre-qualify the tenant first, and then allow them to select the home they wish to occupy and later purchase. Of course, this is within the investor's guidelines. This unique matching approach increases the probability that the tenant ultimately purchases the property. This process creates a built-in exit scenario. To recap, the tenant will exercise their option to purchase the home within, say, 2 to 3 years. Note that to purchase, the tenant will need to have budgeted a 10% down payment to make the purchase. The investor, you, provide financing on land contract for an additional 2 to 3 years, meaning you still hold the title to the home, but are starting to collect mortgage payments instead of rent. If and when the tenants qualify for conventional financing, perhaps sooner than that projected time period, both parties will benefit from an earlier cash out. And the last slide summarizes the concept, the process, and the investment. Home investing with absolutely no landlord issues, with a great projected return on your investment, excellent tax benefits any way you finance your investment, and a built-in exit scenario.
Well, thank you, Michael, for taking the time to walk us through this today. If you're reviewing this presentation at home, you can reach IBAREE on their website at IBAREE.com and simply click on the Contact Us link to fill out a contact form or to find IBAREE's telephone number.